Now I want to talk about the S Corporation, which is a wealth building tool the rich have been using for years. I'm a tax lawyer. I've helped thousands of clients establish and use S Corporations. I use one myself, and we're going to break it down and show you how it works. Now I'm going to get into a specific example here on how the strategy works, how it's going to put more money in your pocket, which helps you build wealth. Now we're going to go over someone making $100,000 a year in your business, $600,000 a year in your business, and $9 million a year in your business. I'm going to break it down. It's pretty simple to follow the rules and how this works. Now, the first thing I want to make sure you understand is the S Corporation is not an entity in and of itself. It's a tax election. You could be an LLC, taxed as an S Corporation. You could be a corporation, taxed as an S Corporation. It's a tax election you file to the IRS on what's called Form 2553. Now, I use this. Again, we've had thousands of our clients at KQS Lawyers use this strategy. So let's break down the first principle here. The S Corporation is about saving on self-employment tax, which is Social Security and Medicare tax. Now, you pay that tax when you own a business or you're self-employed and you're receiving income from selling goods or services. If this is your rental property, your investment income, you're not doing this. You don't pay self-employment tax on that income. But if you're a doctor, a dentist, a consultant, you're driving Uber, a lawyer, an architect, a realtor, I don't care. You're selling services or goods, you have to pay this tax. So let's first break this down as if you're just a sole proprietorship. Let's say you have an LLC and you make $100,000 a year. The first thing to understand is the self-employment tax rate is 15.3%. Now there's a phase out on this and we're going to come back to that here in a moment. But for someone making $100K a year, you just got to worry about 15.3%. By the way, you pay this tax before you pay income tax at whatever tax bracket you fall into. So I'm paying $15,300 in self-employment tax. That's again, Medicare and Social Security. Then you pay income tax. If I'm just a sole proprietorship or an LLC and I didn't make an S Corp tax election, that's what I pay. However, if you use the S Corp strategy, making $100,000 a year, you can do something called a salary dividend split. The reason this strategy exists is in an S Corporation structure, if I make an S Corp tax election to an LLC, or I just did an S Corporation out of the gate, the government has said in the tax code, when you have profits from an S Corporation, dividend or net profit, no self-employment tax. But you do have to pay self-employment tax on your salary that you take as the owner of the business. And you must take what is called a reasonable salary, okay? We're gonna talk more about that here in a minute, what's reasonable depending on your income. Let's say you took $40,000 as a salary, you had to take something reasonable, you're working in the business every day, and you paid yourself $60,000 out as a dividend or profit. Hey, sorry to cut in here. I just want to make sure you know of my law firm, KQS Lawyers, where we help clients across the country save on taxes, protect their assets, and plan their estates. Get over to kqslawyers.com to learn more. We'd love to be of assistance to you. Now back to the video. Now, by the way, this $100K is after everything you expensed in the business, okay? This is your net income you would have been able to pay yourself. Now what happens is I only pay 15.3% over here on that $40,000. Which is going to be $6,000 approximately. If we go over here to the dividend side, 15.3% of $60,000 would have been $9,000. But again, I don't have to pay that because it's exempt. The dividend and net profit income out of an S Corp is exempt from self-employment tax. Now, a lot of people stop here and they're like, well, Matt, why don't I just pay $100K out as dividend, no self-employment tax on it at all, and I'll pay myself no salary? Well, the IRS knew you would do that, and they say if you work in the business and you're part of it, you must take a reasonable salary and compensation. Well, what is reasonable? Well, here I think a lot of accountants and CPAs that understand this strategy, that have read the cases and understand it, would say, all right, I'd be okay with you, depending on your situation, taking $40K of salary and $60K of dividend. Now, it might be a 50-50 split, 40-60, 1/3, 2/3. We have a lot of clients that do that. And it's going to change as the income goes up as well, depending on your involvement in the business. But right now, very simply, someone making $100,000 a year using an S Corp strategy is going to save $9,000. You will save $9,000 every year because you filed one form to the IRS, a 2553. Now, when you're executing this strategy, you're going to start doing quarterly payroll reports. You will have an S Corporation tax return. This might cost you $1,500, $2,000 a year to do the tax filings and paperwork. Hire an accountant. focus on growing your business, hire an accountant or a CPA that understands this and will handle this for you, okay? You need to outsource this stuff. You're ahead still $7,000, even though you paid a professional to go do your taxes and everything, which you're probably gonna find more savings anyways by having them. And you can take back that time where you're doing your tax return on TurboTax and go make more money in your business. All right, now as your accountant is doing these tax forms, two things are gonna happen. You're gonna get a W-2 over here for your salary, and you're gonna get a K-1 over here for the net profit, dividend, whatever you wanna call it, over here where you're not paying self-employment tax. So we're bifurcating the income here, and that's the whole magic of the S Corporation strategy, is getting as much over here as I can into net profit or dividend, which is exempt from self-employment tax. All right, now let's look at someone making $600K a year, all right? Now the math changes here a little bit because there is a phase out on self-employment tax. Once you hit a certain threshold, you max out on how much Social Security tax you have to pay. And this makes the numbers adjust a little bit. So I have a lot of high income earners that say, Matt, should I still do the S Corporation strategy? I phase out on my self-employment tax. I'm a doctor making $600K a year. Does this actually help me? Yes, it helps you. You'll actually save more than the example I gave you because you're making more. And here's how the math works on that. So let's say you made $700K a year. You're a doctor, dentist, whatever, high income earner, consultant, and this is after all your expenses, okay? We've got $600K a year. Now we might say here you took a $100,000 W-2. All right, we're gonna come back to this and how do you know what's a reasonable salary, but I'm gonna show you this so you understand the math and how it works. The other $500K here, you're gonna take as a dividend, or again, this is your net profit that's gonna come through on the K-1. Now here, I'm paying 15.3%, right? So on 15.3% here, I'm paying $15,300 on the W-2. Now, I gotta break this down because what that 15.3% is composed of is 12.4% is going to Social Security and 2.9% is actually Medicare. That's how you get to 15.3. So this is really 12.4 and $2,900, okay? Hang with me here. I know there's math, but there's tax savings here for you, okay? So this math pays, this is money going back in your pocket. Think about it that way. All right, so I had to pay $15,300, but what did I save, Matt? What did this strategy save me? Now, here's how the math changes because you're over the phase out here, all right? So the phase out for 2025 is $176,000. What that means is over $176,000, you only pay Medicare of 2.9%. You stop paying into Social Security, all right? So I've got to pay this 15.3% still on 100,000 to 176. By doing this strategy, I got out of $76,000 at 15.3% because I still had to pay Social Security and I had to pay Medicare on that. And that saves me $11,628. Just the savings on that $76,000 because I pushed that $76,000 over to dividend or net profit instead of it sitting over here where I would have had to pay it if this was an LLC, I'm a sole proprietorship, I didn't do the S Corporation structure. All right, but now I've got another $324,000 left here that's coming through as dividend, and I don't pay into self-employment tax for the Social Security part, but I still have to pay the Medicare part of 2.9%. Now here at 2.9%, that's $9,396, okay? I'm still saving $9,396. So combined here, I'm saving $21,024 by doing the S Corporation strategy. Now, that's every year you're operating this business, making this income level, choosing to be an S Corporation, it's saving you over $20,000 in taxes. So for those that are asking and are saying, but Matt, I'm high income, I phase out. Should I still do the S Corporation strategy? Do you like $21,000 in this example here? If you do, the answer is hell yes, you should. You should definitely do it. This will keep more money in your pocket, which you can use to grow and scale your business, to put into investment assets, to use with your family, to retire faster, whatever it is you want to do. This 20 grand a year here is going back to you instead of going to the IRS. I consider that a win, and that's actually how you're going to grow and build wealth. All right, now let's look at someone making $9.5 million a year. Why do I use that example? Because I wanted to show someone making millions of dollars a year how the S Corporation is going to save you hundreds of thousands of dollars. And I also want to talk about the salary versus dividend that you're taking when you're an extra high income earner. Now, this example is Joe Biden's S Corporation, Celtic Capri Corp. He had to release his tax returns when he ran for president, and it showed what he was doing with speaking fees and selling his book and consulting. All his income was going into his S Corporation. Well, what did he do? He had $9.5 million of net income into that S Corporation. He took a salary of $146,000, and he took dividend net profit of $9.3 million out of that S Corporation. Why did he do that? So he didn't have to pay Medicare and Social Security tax on the whole thing. That's the whole reason you do this tax strategy, all right? Now, I don't want to be political here, but I just want you to show you this is someone's disclosed tax return that was highly scrutinized, all right? This was a reasonable salary. Okay, so what he took here, $146,000. Now, there was $30,000 left here, if we're in 2025 numbers, of what would be 15.3%. He would have had to pay into Medicare and Social Security tax on that up to $176,000, but he didn't. He stopped at $146,000. That saved him $4,590 because that $30K was otherwise pushed over to a dividend. All right, now the rest of the money he took as a dividend or net profit, which was the other $9.3 million here. And in that bucket of money here, we're saving 2.9%. All right, that is the Medicare tax you pay to infinity and beyond, but he didn't have to pay that, okay? If he was a sole proprietor, this was hitting Schedule C, just had an LLC, did not do the S Corporation tax election, this is what he would have had to pay, and this is the tax saving, 2.9% on $9.3 million, which is $269,700. Now, if we add that with what he saved over here on the 15.3 and what he saves over here, that's $274,000 of saving. Again, the secret here is we're pushing income over to the dividend net profit category, taking a reasonable salary as low as we can. We do pay Social Security on that up to $176 and Medicare forever. So, but his savings here was $274,000 in taxes every year. Now, the reasonable salary here depends on a number of circumstances in your business. We have a whole payroll matrix on this. My partner, Mark Kohler's got the Kohler payroll matrix. Our lawyers at KKS Lawyers can walk you through this, whether you're making $100K a year, $300K a year, $1 million a year, $10 million a year. We can walk you through this strategy and how this salary dividend split works for you and the tax savings that will be going back into your pocket once this is implemented. Now, get over to kkslawyers.com if you need help with this. Maybe you have an LLC, you just need a tax election to it. Maybe you need to restructure the whole thing and rethink it. We do a comprehensive tax and business consult at our firm. We look at your prior year return, and we'll help you analyze it and make a strategy and plan moving forward. We'll give you a tax implementation plan. This would be just one strategy of many we might implement to help you save on taxes. Now, that doesn't cost tens of thousands, hundreds of thousands of dollars. It's going to cost you a couple thousand, a few $1,000s, depending on your situation and the complexity. Our team can help let you know what that costs to be. So get over to kkslawyers.com. I hope you found this video to be helpful. I've got a lot of education and resources here on saving taxes, protecting your assets, and building wealth. Please subscribe to my channel. I'm Matt Sorensen. See you next time.